Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I'm scrolling through the comment section, like to hit some of your guys' questions. It says, can someone explain the copper to gold ratio, please? Gold price is primarily investor driven, and since it's a precious metal, but copper is an industrial metal, and price is primarily driven by how much copper the industry is using. So what is this ratio actually showing? Is it a slowdown in industry? I haven't come across the ratio before, just looking to understand what I'm seeing. So that you've described it quite well. Copper is used in industry, and what happens is under certain market conditions, copper outperforms gold, and under other market conditions, gold outperforms copper. So really, it's more or less driven, I would say, by copper and the demand in industry for copper. So when copper price starts to go up at a faster pace than gold, it means that we're building things in the world. That demand in the world is accelerated for copper. And another thing that it also means is that inflation is kicking up, because some of this stuff is driven by financial means. So you may have more preference even by countries to buy copper over, say, bonds. So when inflation kicks up, and usually this is from the real estate market, and there's also demand for copper in real estate as well. When inflation kicks up, and let's say it's caused by real estate, and so inflation kicks up, it puts bonds in a real negative yield. So people don't want to buy bonds, and they say, well, where do I put my money? Some countries will say, just go buy commodities. It's better to buy commodities and restock our commodities than it would be to buy bonds and lose money purchasing power in bonds. So that's what they do. Countries, people, hedge funds, they go and they buy commodities instead of bonds. So it is financially driven, and it's also driven by supply and demand. It's both of those things. So that's where, if copper's outperforming gold, it means that the market conditions favor commodities. It also means that a crash is most likely not likely. If that were to reverse, where copper plunges and people sell copper, the financial types will, they usually know what's up before everyone else. It's like they have this information, and we don't know what that information necessarily is, but we can see it by how they're trading and what they're trading. And the copper to gold ratio, if they dump copper and it tanks, it tanked before COVID. The banks knew that they were going to do a shutdown before the shutdown occurred. That's why you saw yields drop and copper to gold ratio drop and copper tank. They sold all their commodities and piled into bonds because they knew that rates were going to go down in a crash. People were all going to pile into bonds, and if you see that, your yield would go down. And that's exactly what happened. It means that they knew what was happening before it happened. Here's some more. This person buys more physical metals. I do too. I think it's the lowest risk way to play all this. It says, for copper stocks, what do you think about of producers versus juniors? I'm trying to figure out the best way to play it. It seems that the capex for a copper mine is so huge, most juniors cannot do it themselves. I agree with that, and I do not have a lot of money in copper junior companies. It's very little. Where I put my money is in the big diversified mining companies or the royalty companies. I put it, my speculative play is Nova Royalty, NOVRF. And the reason I'm going into Nova is because they know exactly what you're just describing. And you can listen to Alex Sukernick. He's the CEO of Nova, and kind of get his opinion on YouTube. He does post a lot of videos to see what his opinion is on why they're getting royalties in certain areas. What he's doing is they're grabbing royalties on with the other party, their counterparty, are the big diversified mining companies, the big boys, like a Teck or a Rio Tinto or a BHP, the big companies. So their counterparties are the big companies that have a lot of money. They're big projects, very large projects that I think they're going to go into production at some point. And they're getting the royalties on those big boys because, one, they have low counterparty risk with the big mining companies that are well capitalized and can get more capital. They're big projects, which means that he's getting them before they're producing. So he's getting a very good price he can upfront cash to some people and get that value for the company at a very good price. And then what he has is when these companies, they'll start the mine, they'll get it going, and then they'll expand, which means their production goes up. When you have royalties on something where their production's increasing, you get larger and larger royalties over time. So I think that it's a real smart way to accumulate royalties at very good prices because they're not producing. They're all kind of development stage, developing their mines. You've got he calls it the optionality, where this thing grows in size over time, which means the royalty is going to make more and more money over time as the mines grow. And since they're still in development stage and they've really just poked, what we'll call it, poked some holes, got some data, they can grow that resource base as well, which means that if you have a royalty on it, you can grow your reserves over time. So they can grow production, grow reserves, and you're getting it at the cheapest price. And you're before this big commodity bull market. So I think that's a really smart, they're doing something very smart. They're gathering a whole bunch of different royalties, a diversified group of royalties against a bunch of big diversified mining companies. I think is pretty smart to do. So that's the way that I like. I mean, I like that business model. I think Alex can do a good job if he's out there working for us, every single day trying to get more royalties for us. Then I'll take the bet. I'll put a little bit of money in it and I'll ride it higher. And if we're buying it at kind of at the beginning of a bull market, I still think this is a really good opportunity to get in very cheap and then just hold on. And it's still a really good price, NOVRF. And I'm not trying to sell you guys on it. Do your own research. See what the royalties they have. See who their counterparty risks are for the companies. See what projects they're in. And they're going to continue to grow it. And they might get some near-term cash flow. They might go after some near-term cash flow as well. So that's good. Coming over here, there's another thesis that this guy may have, a demographic expert. I can listen to that later. Some people are talking about oil. And so oil, I was thinking that we were going to have a little bit of a pullback here, and all it did was go sideways. I was like, man, that's super strong, and we're starting to see some of the buyers step back into the companies. And this one said, I think we've had our pullback already here in October for oil, seen mostly in the oil and especially gas stocks. A lot of these companies are still down from where they were on October 1st. And guys, this is like a small little pullback. I mean, a month is nothing. Cold weather is upon us, and I don't see a pullback in November, December. I see a surge higher, especially from natural gas. From a contrarian perspective, oil stocks should be sold and gold and silver stocks should be bought because oil stocks are at highs and gold, silver stocks are at much undervalued and have much more upside. However, I am betting in the short to medium term, oil and gas keep going higher and gold and silver have not bottomed yet. In fact, sold off some of my shares in those companies, taken profits and plowed more money into SM Energy. So and he talks about Steve St. Angelo. He's the SR Rocco report or whatever. And he's pretty good. I like Steve. He's got good stuff. But I don't go in and out. I just buy this stuff and hold on if the ratios are compressing, and they are compressing in the gold to oil ratio. I also think that silver is going to do incredible over this period. You have to think, like, if we're going to go to this renewable route, it uses a copious amount of copper and silver. So if governments around the world, if they're not going to say, let's go invest in oil, and they're going to dump it into renewables, we are going to have a massive boom in silver and copper. So I'm getting positioned in copper and silver in the mining companies because, one, I own the physical metal of silver. I'm not going to buy copper. It's just I would end up with a garage full of copper, literally. So what I'm doing is I'm holding on to the copper royalty, Nova royalty, and EMX and FNV. They have copper and precious metals, and I'm kind of going in that route. So I'm owning the royalty companies, and I'm going to hold on to my energy companies, oil and natural gas, and uranium, and I'm not selling those. There's no way. No one's getting my shares. I'm sorry. And I'm going to continue to buy more. I'm not selling anything, and I'm not playing seasonality. I'm not trying to time things in and out. we could hit a crisis here and this thing could go far higher than where we are. We could double the price of oil in a year. Why would I be trying to time this in and out? We're going to have a crisis. It's coming. It's right in front of us. We're eating through inventories. I'm just letting it go. Let it go. Let it make me money. I'm not trading in and out. My biggest position is SM Energy. My second biggest position is CDEV. That's Centennial Resource Development. I've got big positions in Contango Oil and Gas, in Callan Petroleum. I made recent positions that are somewhat large in Northern Oil and Gas, Crescent Point Energy. I own a lot in Crew Energy. These are all the oil ones. And I own a bunch in uranium, a whole bunch. And I just keep piling into it. I think energy is going to be priced far higher than where it is today. So I'm in there. I'm not going to do anything. I'm just going to hold on. The big trend is higher energy prices, and we're at the beginning of this bull market. We're not at the end. We're at the beginning. There's a lot more in front of us, I think, in terms of valuation runway that we can eat up in front of us. So that's my opinion. So here's a question that comes to mind when considering your theory that market crashes could be predicted by housing starts, 10-year treasury yields, and copper to gold ratio. Is that we live in an unprecedented time in terms of central bank intervention. The Fed is creating enormous, vast quantities of currency and using it for things like propping up markets, suppressing treasury yields, and creating other unnatural market distortions that cause a misread of pricing signals. Have you considered the effects of central bank policy and its unprecedented levels of currency creation and the resultant distortion of market signals? And do you maintain your theory that will still hold strong given these gross distortions of market conditions? Really good question. And my answer would be yes. I still think that all of this is going to play out the way that we'll call history has played out. The reasoning behind it is we are going to an expansionary phase of real estate. That's the housing starts. What that does is it opens the floodgates for the money. So they were creating money back in 2009. They were manipulating all this sort of stuff in the markets in 2009. What happened in 2009 is the floodgates of the money going into the system were closed. They couldn't get into the system. Loans weren't being made. We were basically destroying loans through foreclosures. And it was a deflationary environment in 2008 and 2009. So that money was created, but it couldn't go anywhere. It was stuck in the system. It was stuck in the banks. And that the structural the structure underneath the market was broken. It was deflationary. That was the cycle we were in. And that money creation didn't do anything. So they could try to distort and manipulate anything they could through money creation and trying to do this stuff, but it couldn't really fix the problem. All they can do is print money. That's it, and try to mess with yields. But the market had too many homes. There was a flood of homes, and that it created a market condition that was favorable for stocks because yields went down, and we couldn't get inflation. Now the floodgates are open. We have low inventory. We need to build more homes and all these different things. Rent prices are rocketing higher and the floodgates are open. So what they're doing is they're printing money with the floodgates open, which is causing inflation. And inflation is going to naturally put pressure in certain areas that they can't control. They can hold rates down, but all it's going to do is create a larger real negative rate, which means that people are going to be less likely to buy bonds and flood money into commodities. So really what's happening is you're saying that is not really you're saying, but what you're trying to get at is that they're creating a whole bunch of money. And what I'm trying to tell you is the structural underlying market conditions underneath is going to flow money into these undervalued assets because inflation is going to have an impact on interest rates. The money creation is going to amplify the move. It's going to make the move even worse. People in the market, banks, myself, and everyone else, what they're going to do is they're going to start to pile into commodities. And the the Federal Reserve and government and whoever else is trying to do whatever distortions here, they can't guide the money. They're not the ones guiding the money. They're trying to guide it. But where they're going to fail is the undervalued area is in commodities, and the money is going to naturally rotate into it with the floodgates being open in the expansionary phase of real estate. So all the money, and they're creating a whole bunch more, is going to flood right at where we're at. And it's going to be the biggest flood that we've ever seen. Because as inflation goes up, with the floodgates being open of currency creation and the floodgates being open in expansion phase of real estate, which is credit creation, the money's getting from the banks into the hands of people through credit creation of loans against new homes. It's going to put interest rates, that's where interest rates are going to want to go up. So they're going to have to hold interest rates down to prevent money from flowing out of stocks and bonds. Money's going to flow out of bonds no matter what, because you'll have a real negative rate, and go right into commodities. This could be the biggest flood of money coming right at commodities all at once. And they're creating money on top of it. So I think that they are actually creating a larger distortion, which we had a huge distortion from the last housing crash. We're creating this massive distortion that's going to come up, where we can make so much money in the commodities sector, where all of this money is going to flood at it. Now, if we have an energy crisis on top of this, you're going to see inflation work its way through the CPI numbers as well, because that's where it starts. It starts at oil and works its way through into products, because oil is used everywhere in energy. If we have an energy crisis and we're not investing in oil, and renewables aren't the answer, and you've got all this money with the floodgates open that they continue to print, this is going to be absolutely ridiculous for potential increases in oil prices, for potential increases in other energy sectors, and for the increases in commodities itself. We're going to see a massive move higher. Massive. Like, it's going to blow your mind how high this could go on the commodity front and precious metals front. And where that money is going to come from is the Federal Reserve and the money rotating from bonds and stocks, where all that money went into bonds and stocks. And that's where your inflation went, is into those sectors. That's all going to unwind and go back to commodities because of inflation, higher interest rates. And if we don't get the interest rates, the inflation's still there. They can't do anything about that inflation. That puts everything in a real negative rate, and it's going to flow money back into commodities, and everyone's going to be FOMOing at the mouth. Fear of missing out, and they're all going to run back into commodities or oil and gold. So my opinion is the money's not there yet, but it will be there soon. And gold and silver and all these in 5 or 10 years will be the new crypto, will be the new spot to be. It will be the new stock market. And all of these valuations are going to change over time, where commodities are going to outperform stocks. And we're seeing the outperformance. If you go back and look at my ratio video, we're seeing that outperformance here in the short term. All of these long-term trends are being broken to the upside in all of the ratios, and the ratios that like the copper to gold ratio, the platinum to gold ratio, they're breaking and moving to the upside, which means the commodity bull market is coming. It's right in front of us. That's what those ratios mean when these two metals outperform gold. So I think we're going to see a big bull market coming. Huge. The biggest that we've ever seen in anyone's life. And I'll end it there. If you guys are interested in following this stuff, subscribe to the channel, give me a thumbs up, and thank you for listening. This is Finding Value.